Hello and welcome. For the last 25 weeks, we've been getting you expert analysis and the top economic policy developments that affect the nation. And we are grateful for all the feedback and reviews that we've been getting. This is Policy Watch and I'm Athar Khan. Before I introduce my guest this week, here's a quick look at what's making the headlines. Presidential hopefuls filed their nominations before the returning officer Pranab and Sangma both exhibit a show of strength. Team 1991 is in charge again as PM Manmohan Singh takes charge of North Block once again. Advisors Rangarajan and Montek Singh to play crucial roles. PM's first orders are to revive the animal spirits in the economy. The RBI intervenes again and announces measures to arrest the rupee slide and boost the economy. In some relief for consumers, petrol prices come down again. Prices reduced by 2.46 per litre in Delhi. Those were the headlines. And this week, I welcome back to the studio one of our first ever guests on the show, Maithili Basnurmat, consulting editor with the Economic Times. Great to have you back. As Pranab Mukherjee demits the office of the finance minister, the Prime Minister steps in charge to take charge of the finance ministry. And he surrounded himself with the same core team that was in charge when Manmohan Singh was finance minister back in 1991. And the same team that is in fact credited with the path-breaking reforms of 1991. As finance minister then, along with aides C. Rangarajan, Montek Singh Ahluwalia, as well as Jairam Ramesh, Manmohan Singh presided over the liberalizing of the Indian economy. Will this innings by Team Manmohan will it be as fruitful? That's what we're going to ask our guest today. Do you think there's a sense of anticipation that now that Dr. Manmohan Singh has taken charge of the finance ministry, the first orders that he gave his core team was to revive the animal spirits, use reverse pessimism, all these words being bandied about. What is your reading of the situation? Do you think that is going to happen again?
Not so easy, Athar. First of all, I think our expectations are a little unrealistic because it's very difficult, in fact, in any case, to do an encore. So what he did in 1991, and sometimes I think the credit does not belong entirely to Dr. Manmohan Singh. It goes in large part, it has to be shared with the former Prime Minister of the day, Narasimha Rao, because whatever the finance minister does, he is essentially a spokesperson or a spokesman or the mouthpiece, as you were, call it, of the government, essentially of the Prime Minister. So whatever flack or whatever credit the finance minister of the day receives, some of it must be shared with the Prime Minister of the day. So in 1991, if Manmohan Singh had to share the credit that he got for the reforms with Narasimha Rao, today I think in all fairness, he must share some of the criticism that is being directed at Pranab Mukherjee. It has to be shared. So given that kind of background and also the fact that it's not easy to do a repeat, it never is, and also the circumstances before the country today are very, very different. 1991, the country was in a bad shape. The rest of the world was not. Today, not only is India, but also the rest of the world is in poor shape.
And some would say India is far better off than
maybe, yes, one could even say that, you know, relatively speaking. So I think it's a little unrealistic to have our expectations so high. And there is no magic switch in any case to reverse sentiment, animals, bring back the animal spirit. So I think these are just words and one shouldn't read too much into them.
Fair point. I think we agree with what you've just said. Also, I was reading some interesting articles in the Pink papers the day before yesterday. And what they in fact were trying to convey was distilled to its core essentials. Reforms are about choice, competition, efficiency and growth, the so-called CCEG formula. Now, there is a feeling now that CCEG and tough pro-reform measures and steps might be taken now that Manmohan is in charge. My question to you is, of course, what prevented this from happening, say, from, even if you don't take UPA 1, let's take UPA 2. 2009, the Prime Minister was there. All these people, Montek Singh Ahluwalia, C. Rangarajan, Jairam Ramesh, were all in the mix. What stopped them from initiating those reforms since then?
One word, nothing.
Nothing.
Because you use the word that now that he is in charge. But he was always in charge. At least on paper, he was in charge. So the fact is, if he did not exercise that authority, they must be that must be for reasons that were perhaps beyond his control. And that remains even today. So if the Congress party, including the Congress president, is not in favor of very market-friendly reforms, that situation continues today. So I don't see him any more empowered. Yes, he does have Dr. Rangarajan and Montek Singh Ahluwalia to advise him, but they were there earlier also. It says that maybe there is a feeling that now that Pranab, I mean, so I understand from most of the papers, that because Pranab had this overpowering kind of personality and he's been in politics for so long, seasoned politician, the fact that he was in charge of so many EGOMs and GOMs, there was a certain amount of hesitance to take on his opposition even if it, perceived opposition.
Right.
But I think if you're the Prime Minister, you clearly are the boss. And it is for you to show your Finance Minister that you are the boss and tell him what you want, what is the line of action that you want.
Right.
So I don't think one can expect anything dramatically different, number one. Number two, there is really nothing, like unlike 1991, when you could say, okay, industrial licensing goes, and that itself was a big bang thing. Today, there's really nothing very much that you can do on that scale. What you need to do is really work on the nuts and bolts, on the plumbing, as it were. And those are things that will not have any immediate impact.
Right.
They need to be done. They will have a short-term impact to medium-term impact, but nothing overnight.
Right.
So I think it's unrealistic. He cannot do it, and it's not possible for him, even if he wished, to dramatically change things overnight.
Very interesting point there, Maithili. We'll take a small break here. We'll go into our next story after the break. Stay with us. More with Maithili Bisnoormat after this short breather.
Lawyers are using it as a tool to subvert the system.
Bail is the rule and jail is the exception.
Supreme Court judgment is a law.
Media hype and glare on these cases.
It is said that the law is an ass.
So right of the society cannot be ignored.
Law of the land.
A new series on Raj Sabha TV.
Welcome back to Policy Watch. Now, after disappointing industry by keeping interest rates steady in its last meeting, the Reserve Bank of India announced some key measures to shore up investment, halt the slide of the rupee and give a much-needed boost to the economy as a whole. These steps come after the outgoing Finance Minister Pranab Mukherjee had indicated that measures to give the sagging economy a fillip were on the cards. Here's a report. Take a look.
In an effort to boost the ailing economy, the RBI has announced that it will let companies borrow more from overseas in order to pay off their high-cost rupee loans. In another important development, financial institutions like central banks of other countries, sovereign wealth funds, and pension and insurance funds can now invest in the government by buying bonds issued by the government. The new entities wanting to invest money will have to be registered with the Securities and Exchange Board, or SEBI. In what comes as a relief for the manufacturing sector, the external commercial borrowing limit for companies has been raised from $30 billion to $40 billion. And that's not all. Manufacturing and infrastructure companies, as well as those that have foreign exchange earnings that want to repay fresh rupee capital expenditure loans, can now avail of a limit of $10 billion from ECBs. Measures taken by the RBI include letting the financial institutional investors, or FIIs, invest up to $20 billion in government securities. Qualified institutional investors, or QFIs, can now invest in mutual fund schemes that own 25% of their own assets, while in a major fillip to companies with foreign exchange earnings, the limit for external commercial borrowing to pay off loans that has been increased by $5 billion, taking the limit to $20 billion. The economy has shown stunted growth for the past few months, with the blame resting primarily on high borrowing costs, government inaction on key reforms, and a sluggish global environment. Industrial output rose a mere 0.1% in April, while economic growth stood at just 5.3% of the GDP in March, the weakest pace in 9 years. The measures announced by the RBI are expected to revive investments and, more importantly, to arrest the slide of the rupee, which touched its lowest mark of 57 against the dollar recently. Bureau Report, Raj Sabha TV.
There you go. Measures by the RBI taken, I think, last Monday itself. Now, Maithili, won't these measures, some would indicate that instead of following the China model where they allowed FDI first and then concentrated on portfolio investments, wouldn't this sort of make us vulnerable to volatile inflows coming in with cut-and-slash investors looking to make a quick buck? Isn't there a danger of that?
Absolutely. But I think once we've gone down that path, it's very difficult for you to reverse, particularly if your need, as it is in the case of India today, is your need is for immediate forex inflows. Because given the way our current account deficit is widens, almost 4% of GDP, and your inflows have slowed, you need somehow to get that money in right now, right away, to bridge that current account deficit. Otherwise, the rupee is going to depreciate even more. It has depreciated almost 30% in the last 1 year. So it clearly is a very dangerous situation. So when you're desperate and you need money here and now, the only thing that you can do is try and stimulate more of portfolio investment, which is not a good thing at all long term. But in the short term, when you're in a crunch, you don't have too many choices, which is why the RBI has done what it has done.
So you're saying they pretty much didn't have any other choice than
really
to rely on these portfolio
Absolutely.
investors. Right.
Yeah. You could have, of course, tried to reduce your current account deficit, but that is something that cannot again happen overnight.
Right, right. And the government obviously is finding it very difficult to do that. Also, there was another, I mean, there are other risks and concerns involved, saying we could also lose out, instead of choosing to let FDI in first and then concentrate on portfolio investments, we could lose out on the ancillary developments like industries and jobs created. That could also happen.
Absolutely, but that has always been an advantage of FDI vis-a-vis FII, which is why there's been this talk of why don't you open up, whether it's civil aviation, insurance, pension, retail, multi-brand retail. But that, I think, something that politically the government finds more so difficult. So since this has been a government which has always eschewed hard choices and favoured soft choices, I think they prefer to do this, which actually is not very advisable, because given the fact that our short-term debt has been rising, I think the last thing you really need to do is encourage more of the same kind of short-term debt. And it's really, I don't understand the logic of allowing companies to borrow from abroad to repay rupee loans. Because it's not as if rupee loans are not available in India. There is enough liquidity in the system to lend. And the argument that you may get cheaper loans abroad is also not correct, because once you factor in the hedging cost for the exchange risk that you have, the rate of interest will be more or less the same. And if you borrow without hedging, then if and when your exchange rate moves adversely, which is quite likely, then you'll get hit very many times over. So I think the entire logic was flawed, but given the fact that our need was quite urgent, perhaps we didn't have too much of a choice.
Also, one point that people have been talking about for a bit now, and Ashwani Kumar immediately after the S&P downgrade said we have infra projects and they'll bring investments back in. But given the current global scenario, would it surprise you if investors are not making a beeline towards India because they're not very sure?
Not at all, because as I said, you can ease up on your front, but for anything it takes two hands to clap. So you must have foreigners willing to invest in India. And given the kind of adverse reports that India has been receiving, where there's even talks about, Goldman Sachs, are we going to be a fallen angel? There's talk of Indonesia replacing India as the eye in BRICS and all that. It's not likely at all that foreign investors would look at India, even in a good scenario. And with the world economy being what it's like and people looking in terms of safe havens, I really doubt if investors would really bite.
So would you see then this as a sort of a knee-jerk reaction to economic problems rather than long-term planned projects? Like, shouldn't the government be concentrating on clearing hurdles for infra projects, ports, for example? Do you think these measures come as a knee-jerk reaction more than anything else?
I don't think it was a knee-jerk reaction. I think it was well thought out. But the thing is, even if you do ease up on infrastructure and your policy framework, the money will not flow in immediately. Whereas portfolio investment, the advantage, quote-unquote, with that is that you will have money looking for make a quick buck. So if you're not bothered about the quality of the money and you only want quantity, then perhaps this was the best of the options. Long term, yes, it is not good, and even short term, it is doubtful. But there are chances that it will have an immediate impact. So you chose. As I said, it's a lesser of the evils.
India Inc. and the markets also sort of shrugged these measures off. We'll take a look at what the response was for these RBI measures. Even as the RBI announced some key measures to support the free-falling rupee, it failed to cheer up markets as they ended in the red again. Industry, on its part, says they expected bolder steps in order to revive sagging growth and arrest the currency slide. Here's a report. Take a look.
In an indication of how the markets and the industry received the steps the RBI took on Monday to arrest the fall of the rupee, the markets, after an initial spike, fell into the red again at the close of business on Monday. The benchmark Sensex closed at 16,882.16, down 90.35 points on Monday. The markets had touched an intraday high of 17,131.15 and a low of 16,853.05 earlier during the day. Central Bank eased ECB norms by increasing the FII investment cap in government bonds $20 billion from $15 billion. The ECB limit for new manufacturing and infrastructure projects was hiked by $10 billion. While market voices say that it wasn't the shock and awe that they expected, the industry seems to be hanging on to what else might be announced in the days to come. The feeling in India Inc. after the announcement seemed mixed. The reason attributed to the muted response of industry is the fact that most economists believe that using more foreign currency to stop the fall in your own currency could be unreliable, and the fact that limits have been eased for portfolio investors doesn't necessarily mean that investors are lining up to put in the inflows. Top policymakers have also hinted at more measures that will be introduced in the days to come, with financing oil companies for oil imports being one of them. The government also hopes to raise non-resident Indian bonds, or resurgent India bonds as they are called. In the meantime, the markets as well as the industry wait with bated breath for the current set of measures to take some effect. Bureau Report, RSTV.
There you go. In markets, very cold in response.
Yeah.
Monday, they ended it in red as well. The industry, I've been speaking to people from FICCI and CII, and they immediately shrugged off, saying that it doesn't really help us. Now, some people have suggested, Maithili, that by and large, industry voices, some of them said that merits of these proposals are suspect. One, why? Because the existing ceilings on these, they haven't been exhausted yet, especially if you put out government securities and keep them away. I think that has been kind of saturated. But otherwise, those existing ceilings haven't really hit it yet. Do you think that could be a problem, easing it further when the existing ceilings haven't been touched yet?
Yeah, precisely, Athar, because as I said, it's also a function of how the world economy is today. And there isn't that much money that, really footloose capital looking around. And though corporate bonds might look attractive in terms of the rate of interest, the fact remains that corporate bonds are also in India. When a corporate bond is not paid, when it's not repaid, then the entire mechanism actually getting your money back is very difficult. You have to go to the company law board, etc., which is why corporate bonds, even domestically, haven't taken off. There are huge issues there. So I think it was a little unrealistic to expect that much money would flow in. In fact, to my mind, I think maybe if you had something like the Resurgent India bonds or the Millennium deposits that you had earlier with NRIs, because the experience with that has been that whenever you have NRIs investing in these instruments, when they mature, a lot of the money remains in India. It's not that NRIs are any fonder of India than of any foreign investor, but it's just that they have needs, they have family, they have some greater interest perhaps. So when these bonds mature, they do not tend to go out as much as in the case of foreign investors, outright FII investment. So to that extent, I think that would have been a better option. We've done it in the past twice, thrice. So I'm a little surprised that the RBI and the government did not adopt that route.
And there has been some proposals and some talk. Mr. Rangarajan indicated that the bonds could be looked at. Immediately afterwards, the finance ministry clarified that no dollar bonds yet. So there is some talk of that happening. Also, top policymakers have indicated there could be some other steps in the coming days. And again, Dr. Rangarajan gave a hint, perhaps selling dollars directly to oil companies, giving them cash directly. Do you think if that happens, that particular proposal, if that goes through, do you think that will be able to stem the rupee slide in any way?
Yeah, it would immediately help because you would get the supply of dollars position on the market would immediately improve. But that's, as I said, putting Band-Aid. It's not a complete answer because what you really need to do is deregulate your oil prices. You've done it in the case of petrol, you've not done it in the case of diesel, not done it in the case of kerosene. So as a result, when oil prices rise and that price increase is not passed on, you don't have the normal response by way of a contraction of demand to higher prices. And that's, I think, the kind of reform you need to know. In fact, we've kind of been looking for Band-Aid solutions for long enough. I think we need to look at more permanent solutions. And until we do that, I think the markets are not going to kind of be particularly enthused.
Absolutely. Very interesting. We'll talk about petrol and the recent cut in petrol prices after the break. Another short break, more with Maithili Basnurmat, and we'll talk about the petrol cut that just happened very recently. We'll talk about that after this break. Don't go anywhere. Welcome back. You're still watching Policy Watch. Now, the price of petrol was cut by 2.46 per litre, the second reduction this month. Petrol in Delhi will now cost 67 rupees 78 paisa per litre, with effect from midnight, in fact, last night, as compared to the 70.24 litre rate state-owned oil companies announced on Thursday. The reduction in rates follows a 2.02 per litre cut in prices that was effective from June the 3rd. The two price cuts have wiped out more than half of the massive 7.54 per litre increase in rates, the biggest in the last 10 years, effected last month. Now, Maithili, of course, this is the second price cut this month. We expected a first price cut immediately after it was hiked. Did you expect this one as well?
Not really, but I think what has happened in the process is the government sends a message that you're not able to stick to tough decisions, even though the reduction might be as a consequence of oil prices falling internationally. But I think what one really needs to do is to depoliticize the entire pricing of oil. If oil prices were to change daily, like the price of gold, then people would stop looking at oil prices as a political decision, number one. Number two, you haven't depoliticized the oil pricing completely, because diesel and kerosene, LPG, these are still highly subsidized. So I think and petrol really doesn't account for a large part of your total oil import bill. So what you really need to do is send the message that, look, oil prices domestically will be linked to what the international prices are. If they go up, they'll go up here. If they fall internationally, they'll fall here. And once consumers get used to that idea, you'll have much more efficient use of oil commodities, oil-based commodities. Number two, people will not have, you won't have this huge middle-class anger and furor and left parties screaming. Whereas actually, if you look at it, except for diesel and even kerosene, LPG, petrol is used only by the middle class and upper middle class. There's no reason whatsoever why these should be subsidized. So I think that's what the government really needs to do. Today, there's talk of sugar being deregulated. So I think the entire idea of government fixing prices, that is entirely anachronistic, and it needs to go. So I think that is what the government really needs to do.
Some would say it's simple economics. Link the price of petrol to global prices. And what's wrong with that? Of course, that has been advocated for a very long time. But political will, of course, is needed. One more, since it's not happening right now, since we are nowhere close to deregulation of diesel anytime soon, how do you think the government will take care or factor in if global crude spikes up again? Right now, it's easing. That's why the petrol price is down. Do you think the government has thought about that? In case it does go to 125 levels again, how will the government handle that? Will they effect another price hike? Do you think so?
I don't think there's very long-term thinking, clarity on that thought, particularly because as the elections approach closer and closer, it's going to be much more difficult to take for the government to take politically hard decisions. So I think at the moment, in fact, today is a time when you can perhaps think in terms of easing the subsidies, because oil prices are falling internationally. So the government can say, okay, we'll bring out a time frame. Say, okay, every month the prices will go up, the adjustment will be 5%, 10%, whatever flat time frame you wish. As in the case of tariffs, if you remember when import tariffs were brought down, the government had a clear roadmap of how they're going to come down. If you were to do that similarly in the case of subsidies on the other commodities, oil-based commodities, then I think that people would find much easier to digest than this, that, when prices go up, then suddenly you want to hike because the subsidies become too large, and when prices come down, you're not able to pass it on. So I think you really need to have, and today when prices are falling, that's the time for government to ease the subsidies.
One last question, Maithili, before we close the show. Dr. Rangarajan, of course, back in the team now, back in the mix of things. There is talk of him probably being the next finance minister as well. We're not going to speculate, but he has been for a very long time a very strong supporter of deregulating prices, and he's mentioned that before also. Do you think him coming back into the fray and sort of running North Block along with Montek Singh Ahluwalia and the Prime Minister, do you think perhaps now is the time that considerable influence that he has over the Prime Minister and his policy decisions, perhaps something could be done in the near future on the front of deregulating prices?
Well, as the chairman of the Prime Minister's Economic Advisory Council, he always was a sounding board for the Prime Minister. So frankly, it was a more behind-the-scenes kind of influence. Now perhaps he's much more in the open, that's all. But ultimately, the key lies with the Prime Minister. If he wishes, he can act. And if he does not wish, he will not act.
And the time to act is now.
Absolutely. It was actually earlier, yesterday. But at least let's hope that maybe he will act. Let's hope he will do that.
Absolutely. Thank you so much, Maithili, for joining us on the show today. That was Maithili Basnurmat, consulting editor of the Economic Times. Of course, our first story today was the Team 1991 back in action, according to my guests. And there is a feeling in the capital as well. They were there in the mix for a very long time, since UPA 1 began. If they couldn't do anything then, perhaps they can't really do much now. But of course, as always, hope remains. The team is back. The dream team, as some would call it. The hope remains that they might just take some tough measures that are needed to give a boost to the sagging economy. The second story on Policy Watch this week was the RBI measures taken to give that exact boost to the economy. Market and industry responses were really cold. Markets ended in the red. Industry sort of shrugged it off, saying that this is not what we want. We need a far more tougher steps to take. Of course, Maithili also agreed that the long-term planning and strategy has to be in place. You can't really have knee-jerk reactions to it and take it through a piecemeal way. Of course, long-term strategy is required. We talked about petrol prices and oil prices as well. There's a petrol cut just recently. Like Maithili said, deregulation is the key. Petrol prices need to be depoliticized for the middle class, of course, to absorb the shock of any spikes going up or down. And that, of course, is the key to long-term solution to petrol prices going up in the country. Thank you so much for joining us on Policy Watch this week. That's all the time we have. Till next week, when we get another guest and the top economic stories of that week. This is Athar Khan saying goodbye and thank you for watching.